You might think you've seen it all when it comes to market crashes. But there's something hidden in plain sight, a pattern that repeats itself right before the storm hits. It's something most people ignore. Until it's too late. Before the markets plunge, before the economy takes a nosedive, there's always a distinct set of signs that predict the crash long before it happens. You've heard the term market correction. But have you ever wondered what really triggers it? The signs are subtle, often dismissed by the majority. But financial history has proven that these events always precede a crash. And today, you're going to discover what they are. Before we dive in, if you want to stay ahead of financial trends and get the latest on what drives the markets, make sure you hit that subscribe button, give this video a like, and share it. Trust me, you don't want to miss what comes next. It often starts in the most unexpected way. In the calm. The stock market is booming, the economy appears to be growing, and confidence is at an all-time high. Everyone's feeling good, the markets are on fire, and people believe the good times will last forever. But here's the thing that most people don't realize. Before every major market crash in history, one thing almost always happens: a massive disconnect between market performance and economic reality. Yes, you heard that right. Before a major financial collapse, the stock market begins to separate from the fundamental health of the economy. You start seeing companies, industries, and entire sectors soaring to unsustainable heights, even while the economy underneath begins to show cracks and signs of weakness. It's as if the market itself is living in a state of denial, completely detached from the real world. Let me give you some context. Look back at the dot-com bubble of the early 2000s or the housing crash of 2007-2008. In both cases, an unrealistic, almost euphoric optimism flooded the markets. Tech stocks skyrocketed in the 90s, even when the companies behind them weren't actually profitable. In the housing market, banks were handing out mortgages like candy, even though many borrowers could never afford to pay them back. And then, when reality finally hit, that disconnect collapsed, and we saw what happens when the truth catches up. But wait, there's more. There's another sign that always precedes a market crash, and it's a powerful one. Speculation. Speculation is the lifeblood of financial bubbles. In any overheated market, people begin to gamble. They stop buying based on logic and fundamentals. They start buying based on hype and hope. You see it everywhere in financial markets. Take cryptocurrency, for example. It experienced an intense speculative frenzy in 2017, when the price of Bitcoin shot up from a few $1,000s to nearly $20,000. In the real estate market during the 2008 crisis, subprime loans were handed out based on the speculative belief that housing prices would never, ever go down. But here's the thing about speculation. It's built on nothing solid. And when that speculative bubble bursts, chaos follows. The stock market crash of 1929 is one of the most famous examples of speculation gone wrong. Investors piled into stocks, buying on margin with borrowed money, betting that prices would only go up. But when those stocks started to lose value, they couldn't repay their debts, triggering a domino effect that led to the Great Depression. So when speculation is in full swing, the market becomes completely unmoored from reality, fueled by irrational hope and greed. Now, here's where it gets really interesting. Because before a crash happens, you'll start to notice a shift in behavior. It's subtle at first, but it's there. You'll see a rise in fear. This is when panic begins to set in. The first signs that something is terribly wrong. It usually starts with the financial elite. When those with deep financial knowledge and the power to move markets start to get uneasy, you should pay attention. You'll start seeing signs like increased selling among institutional investors or insider trading at unusually high levels. During the 2008 crash, for example, insider selling was at an all-time high in the months leading up to the crisis. Top executives were quietly offloading their stocks before the crash, while the average investor was still buying into the bullish narrative. The housing market saw a similar pattern. Big banks and financial institutions began to short the market, betting against it, while everyone else was buying homes with subprime mortgages. The same thing happens in the stock market when the big players start to bail out of high-risk positions. When insiders start jumping ship, that's when you know the iceberg is dead ahead. That's when the ship is sinking, and only the well-connected seem to have the lifeboats. At the height of any market bubble, the media plays a critical role. But here's the thing. The media often downplays the risks until it's far too late. They'll talk about record highs and all-time achievements, feeding an illusion of safety to the general public. If you're hearing the media constantly talking about how stable the economy is, how high the stock market is, and how there's nothing to worry about, that should be a warning sign right there. In the years leading up to the 2008 crash, the financial media was full of headlines boasting about the housing boom, largely ignoring the fact that the market was built on a faulty foundation. It was the same with cryptocurrency during its wild rise in 2017. Influencers, investors, and mainstream media were all shouting, "This is the future," while very few were looking at the overinflated valuations. And when the bubble finally popped, Bitcoin lost over 80% of its value. It's not just the financial media that feeds this illusion of safety either. It's social media too. People on Twitter, Reddit, and other platforms pile into speculative investments simply because everyone else is doing it. They have a fear of missing out. And that's exactly what happens just before a crash. People jump in at the highest point, and they're the ones who get hit the hardest when it all comes tumbling down. Now we come to the final phase before the inevitable collapse. This is where the last warning signs become undeniable. You see the markets start to get more and more volatile, and the rising uncertainty creates huge, erratic swings. The market no longer moves with steady growth. It starts to look like a dangerous roller coaster ride. Volatility is the killer. In the case of the 2008 financial crisis, this became terrifyingly clear as soon as Lehman Brothers collapsed. That single event triggered a chain reaction of panic selling, wiping out trillions of dollars from global markets. The thing that most people failed to notice, however, is that all the signs were there beforehand. The volatility, the insider selling, the massive debt load. But it was all brushed off, ignored, or downplayed until the crash was upon us. And when the crash happens, the aftermath is always the same. Mass panic, widespread economic pain. People lose their jobs, their homes, and their life savings. Entire industries can be wiped out in a matter of days. And by the time the dust settles, the world is left trying to pick up the pieces. So why does this always happen? Why do we keep falling into the same trap over and over again? Why does this disconnect between market optimism and economic reality always lead to a crash? The answer lies in human nature itself, in our tendencies toward greed and fear. We're all optimists when the market is high, and we tend to ignore the warning signs until it's too late. We believe that the good times will last forever, until they don't. But here's the key. If you understand these signs and learn to recognize the patterns before everyone else, you can be prepared. You can stay ahead of the crash, and that means protecting your assets and your wealth. So the next time you hear about record stock highs or unbelievable crypto gains, take a moment to ask yourself, is this real, or are we about to experience another crash? If you don't want to get caught off guard, subscribe to our channel and stay ahead of the curve. Like and share this video to help others see the patterns before it's too late. Thanks for watching.